I want to start right here. Hedge funds having trouble beating the S&P 500, okay? And they're selling out of stocks massively. So it was interesting. Somebody left a comment on that post. I said, breaking, hedge funds have trouble beating the S&P 500. Somebody said, well, you know, hedge funds, it's not their job to beat the S&P 500. And my thought to that is, first off, yeah, anybody that's in the market knows that. But if you really want to be on the hedge fund side, let's think about this a little deeper. Hedge funds are supposed to protect you and protect your assets, right? So, answer me this. Why are hedge funds dumping out of stocks at the fastest rate we've seen in years when the Nasdaq's already down 13%, when the Russell 2000's already down 19%, and now they're dumping out of stocks left and right? Let me ask you this. Why were these hedge funds not loading up on put options a month ago, 2 months ago? Why did they wait till right now to start loading up on puts? If you look at the put option volume this week, it's been astronomically high. Why weren't they loading up on puts a month ago, 2 months ago? Aren't they supposed to mitigate risk? Oh, so they're not doing either of their jobs. They're not outperforming the market, and they're not prepping up or hedging for their clients at all. Because if they were, they wouldn't have to worry about selling stocks heavy right now. They wouldn't have to worry about put options right now and loading up on put options right now. But as I always tell you guys in regards to hedge funds, one thing matters only. It's that they sound intelligent to their high net worth individuals. So when they go on the golf course with Mr. Johnson and he has $175 million net worth and he's got $50 million invested in the hedge fund and he's with the big dog down there and they're playing golf and he says, hey, you know, man, market, I heard it was going down a lot. You guys did you guys sell? Yeah, we sold. That's all that matters. And they're like, oh, good job, right? Oh, man, I heard that NVIDIA stock was going crazy. You guys own NVIDIA stock? Oh, yeah, we own NVIDIA stock. That's all that matters. That's all that matters in the end. A lot of these high net worth individuals don't really look at it in terms of, well, how much was the market up versus not? Did they really protect my assets? A lot of times these hedge funds will underperform the market when the market's going up and underperform the market when the market's going down. They'll do worse. It's insane. So don't ever try to stick up for the hedge funds, okay? That's what I'll tell you in regards to that. These guys are clueless. They're sheep. They're not clueless in the respect of they understand how to make a lot of money because they understand how to get high net worth individuals to give them their money essentially. But they're clueless in regards to actually understanding the markets and how to actually perform well. Like, you know, hedge funds are no different than any other industry. You got some doctors that are the best of the best and they're incredible. You got some doctors that are meh, some doctors that are bad. You have some teachers that are unbelievable teachers. You have a lot of teachers that are just meh. You know, it's just a job for them, and you got some teachers that are good, right? And some teachers that are bad. Every industry is like that across the board, okay? Next up here. So this came out. AI investor sentiment numbers came out 3 straight weeks now. 55% plus of investors are bearish on the stock market the next 6 months. And then last time we've seen that is March 2009, which is when the great financial crisis stock market crash ended. We had a double bottom, essentially. We had a bottom in the fall of 2008 into the winter of 2008, and then we had that bottom in March 2009. So what's my opinion on this? Does this show me something very important? Yes, it shows me that we're very close to a bottom likely on the stock market. Now, I hope we're not. I hope we're not. Why? I'm 35 years old. I have more income than expenses. If anybody is not retirement age right now, and you have more income than expenses, which I hope is everybody watching this video right now, and if you don't have more income than expenses, get on that ASAP. I'll preach it till I'm not doing this game anymore. I'll always preach it. More income than expenses. If you have more income than expenses and you're not retirement age, you should want the market to keep going down. Why would you not? It just means you're going to make way more money long term. It's a simple game. If I had an option to buy the S&P 500 at 6,000 or 3,000, I would much rather pay 3,000 than 6,000. It's a simple game, okay? But listen. These individuals are all on the bear side right now, and they've been here for a few weeks now, and they're loading up on puts. Market's going to likely switch the other way. My guess is market bottoms here in March, and we start moving up. I hope that doesn't happen. But if I had a guess, if you told me I had a bet $50,000 on the market bottoms in March, or it doesn't bottom in March, and we go lower, over April, May, June, I would put the 50,000 if you forced me to. I wouldn't bet, but if you forced me to bet on one way or another, I'd bet the market's going to bottom in March. Seeing how bad the sentiment is, all this stuff, and everybody getting so tied up into this, right? Tariffs and everything. Dude, as soon as people start getting so used to tariff drama, they're not going to care anymore. It's just going to start rolling off. And once you kind of get all that fear out of there, then you start moving up again. Now, additionally, you know what else this shows me, and this is kind of the scary thing? It shows me how weak mentally the investor community is now. That they were able to go this far bearish, the most bearish they've been since 2009, off of tariffs, off of Doge. We have an unemployment rate right now that's in the 4s. We have inflation that's dead. We have a Fed that's in a lowering cycle. And people got bearish this easily? Wow. It was that easy to make them the most bearish we've been since unemployment was on its way to 10%, since a banking system was collapsing. and we're back there with this? That makes me think, what would happen if we had unemployment rate go to 10%? What would we have happen if the banking system was collapsing? If people got this bearish off of this Trump drama, oh my gosh, you're going to be flipping my flapjacks. Come on, man. Now, stock market crashes. Stock market crashes usually last a little over 300 days, right? And the market goes down about 32%, which right now S&P 500 is down like 10%. So that would be a long way down from here. By the way, if you ever want to follow me on X, I always have that linked in the description area down there. Okay, just so everybody knows. I also have my Instagram always linked in the description area of all my videos. So if you want to follow me on X, some of my posts get quite a bit of views. This one got 45,000 views. This one got actually 385,000 views. So, X has been popping. But corrections, usually SP 500 goes down about 14% on average. So would mean only a few more percent from here. And then usually you recover in about 4 months. Do I feel like we're headed toward a crash? Or is we just still in a correction? My opinion is we're still just in a correction. I don't see a super high probability we're going toward a crash. I would gladly welcome it. Gladly welcome a crash. Once again, as a 35-year-old who's got more income than expenses, like everybody should have, crash. Go down, baby. 50%, 30%, whatever. Doesn't matter. Like, it means nothing to me. Nothing. But on the flip side, I don't think we're going there. I don't think we're going to crash. And the reason being, at the end of the day, is what do we have to go off of to crash? Like tariffs? Doge? It's very questionable how much Doge is even cutting, by the way, and how much they're even going to be able to accomplish. And the tariff drama and those sorts of things, like, what? If you tell me, okay, we're going to have some massive recession, unemployment rate's going to go 10, 12%, okay, yeah, I can see us going down 30, 50% on the market and we're having an actual crash. But to get there from here, it's not going to be easy. And so my kind of thought about that is like, correction. This looks like a very normal correction overall, right? It's a nasty correction. Then Russell was down 19% here today, which means the Russell's very close to a crash. Crashes are usually 20% plus down for an index, and the Russell's getting very close there. So it's in a severe correction. The NASDAQ being down about 13, 14% is in a good size correction. S&P 500 barely just reached correction at a 10% down number. So, the different indexes are at different places in regards to that. No, the White House talking about, they're not concerned about the market. They're concerned about the economy, these sorts of things. As I've been saying to you guys recently, like, it doesn't surprise me at all. Why would they care about the stock market right now? We're not in election time. Midterms aren't about to come up, right? We're not going to have a presidential election. Like, there's no incentive to have the stock market go up short term, right? But there's a lot of incentive to have the stock market go down short term, and we'll get into that just in a moment in regards to Trump. But as of right now, any weakness in the stock market can be put on Biden, right? Even though Trump's in office, Trump and the team, they can just say, oh, this is Biden's stock market, this is Biden's mess we're cleaning up. And you can hear in the rhetoric, his team talks about, Trump and his team. We're cleaning up a mess here, it's a disaster, those sorts of things. So they're just very, very easy to kind of push the blame onto Biden and it's Biden's fault and that's why the market's actually going down. We're having this detox period and these sorts of things. This isn't our fault. This is Biden's fault. And so at the end of the day, like, it's just a very easy time period for them to have the market go down. Like I said, like, by the time midterms come, it's like, that's over a year and a half from now. No one's even going to remember this drop in the market. No one's going to remember this by then. With how fast a news cycle moves and how fast everything goes, dude, no one's going to remember what was going on in the stock market in March of 2025 by the time it's election time and you got to vote for who you want in office. No one's going to remember this other than the people that were super into the stock market like me and you, right? It's all going to move on. No, that gets into Trump, right? Trump says, I'm not going to bend at all. Trump doubles down on tariff plans as stocks sink. He's not concerned about the market. He's Mr. Tariff right now. What's Trump's grand plan here? Okay, here's the deal. Okay, here's the deal in regards to Trump and what he's actually trying to do. This is way bigger than tariffs. Okay, tariffs, blah, blah, blah. What Trump's actually trying to do, he's trying to force the Federal Reserve to start cutting rates substantially. How do you get the Federal Reserve to start cutting rates? Market volatility. It's always been that way. Economic weakness certainly helps. Inflation being dead certainly helps. Market volatility, it always comes back to that. If you look back at every single time period, the market went through tremendous volatility, right? Other than when you're in an insane inflationary cycle or something like that, the Fed always ends up cutting right after. I've seen it continuously. Look back to the tech bubble. Tech bubble, massive market volatility. What's the Fed start doing shortly after? Cutting rates. Great financial crisis. Massive market volatility starts to pick up. Fed starts cutting rates. 2018, massive market volatility then in 2018. What do they start doing in 2019? Cutting rates. Rona, massive market volatility. What does the Fed do? Cut rates to zero. And this will play out the same way. Bunch of market volatility, and what's going to end up happening? Rates are going to start being cut, right? And so that's Trump's grand plan here, because Trump wants to think about, how do I set up the economy to be as good as possible 2026, 2027, 2028, right? The years that he'll really be judged, right? And so he wants to reset interest rates much lower. So then corporations can take out debt for much cheaper. Individuals can take out debt for much cheaper. Somebody can get a mortgage for much cheaper. If somebody can get a mortgage for much cheaper, it's more money they can spend in the economy. It helps real wages, all those sorts of things, right? Could potentially bring down rents, which could also help real wages, right? And then those folks that own those properties could refinance at lower rates. So that's what Trump's trying to do, in my opinion. He's trying to get the Fed to basically cut. And the more market volatility they can cause in the short term, the more the Fed's going to look out there and say, okay, inflation's dead. We're getting a lot more tells of recessionary type numbers. You look at the Atlanta GDP numbers, real-time GDP numbers, those sorts of things, right? You get market volatility. The Fed's going to look out there and say, let's get cutting, because they don't want to get too far behind in regards to this, because they get too far behind. They already got too far behind in the hike cycle when inflation was going crazy, right? So now they can't get too far behind on the other way. So my opinion is the Fed's going to look at all this and say, why are we going to keep interest rates up here? Why? When we have all these data points that are showing us, let's get cutting here. And so I think we'll start seeing 50 basis point cuts across the board, likely many of them this year, and even leading into probably the beginning of 2026, and before they're finally done cutting rates. And that's what I think Trump ultimately wants in the end, right? So that's what's going on here, and I think that's a grand master plan. I got to give Trump's kudos in regards to he actually is pulling it off. The market's getting really volatile. Inflation looks pretty dang dead to me. And you got commodities market that's dead right now. We could look at GSG in a minute if we want to. It's playing out. So he's got it in regards to that, okay? How would you like access to all my best course curriculums? My Becoming Master of the Stock Market course, my Stock Market Investing Mastery course, my Stock Options Mastery course, my Millionaire Playbook. How would you like access to all my best courses, as well as the ability to have access to my 6 and 7 figure plus Discord community, where we're constantly keeping in touch with each other, talking about what's going on in the market? How would you like exclusive weekly videos from me? How would you like the ability to see what stocks I'm buying and selling in my $2 million plus Fidelity account? If that all sounds pretty interesting to you, apply to join my private group. That is going to be linked in the description area down there. You can click on that, fill out an application, and go ahead, hop on a call with Andre. Andre will walk you through the whole process. He'll walk you through the whole group, and you can go ahead and join us in there. Once again, the link for that is in the description area. Alrighty, so let's get into a Tom Lee reaction here. This shall be fun.
And founder of Fundstrat, also a CNBC contributor. Also joining us, Nancy Tangler, Lefebvre Tangler Investments CIO and CEO. Tom, listen, I understand it's a different White House. Every day we get a market-moving headline. A lot of people, I think, honestly, I'm just going to say it, they don't want to be neutral. They don't want to be data-driven. They want to be angry. I get that. But history says that markets will recover, right?
Oh, and one last point. The market's going to start to become immune to Trump. That's the other thing I got to say here, right? You know, Trump just took over, and a lot of people haven't invested under Trump, and so, you know, they're like, oh, like all over the place. Like, Trump came in, he's doing this, doing that, and they're like, oh my gosh, he's doing so much. You know, what? It like shakes their head. Listen, man, the market gets bored. The market has ADHD, okay? The market gets bored of things very quickly. A month from now, I don't think the market's going to care about Trump. Trump could come say this and say whatever. Oh, we're going to do this, going to do that. Like, at the end of the day, the market stops caring, okay? And the same exact thing actually happened in the first term as well. And so, you know, it's just, that is what that is.
Yes, they've recovered every time. One thing we have to keep in mind is when markets fall this quickly from a 52-week high, I mean, just remember, less than a month ago, we were at all-time highs. That is a market pricing in a crisis. You know, I'd say we're almost 50% pricing in a recession, and we're assuming there's no Fed put. Now, the Fed is in a position to cut rates. That really should mitigate the downside. And
hold on. Let's read through what Tom Lee has here, because sometimes they don't mention what they say here. So stocks have overreacted to the downside. Fair. In the 6 precedent swift sell-offs, stocks rebounded 9% in 3 months. Interesting. Expect markets to find their footing before April 2nd. Yeah, people keep talking about this April 2nd. It's going to be so scary. Every time everybody's talking about this thing is so scary, it never ends up actually being scary. So keep that in mind.
I do think 2 other things that investors have to keep in mind, because many people just want to get out until April 2nd, is number one, I do think there's a very high probability that a tariff solution happens before the next 3 weeks happens. And it's simple to see because China, Europe, Canada, Mexico, since April 18th, all of those countries have outperformed the U.S.
Consumer sentiment hits lowest levels since November 2022. And keep in mind, those consumer sentiment numbers back in 2022 were among the lowest we've ever seen in history. So it can't get much worse, right? And that's why I tell you guys, like, there starts to become like some green shoots out there. Like, can consumer sentiment get much worse than this? Not really. Can't get much worse than this, but it could get a lot better over the next few months.
I don't think that markets are that blind to say if Canada and Mexico are about to have a recession, they should outperform the U.S. And I think the second thing people should keep in mind is that when you have a global crisis brewing, and we highlighted like the 1962 Cuban Missile Crisis, that was a 12-day crisis, but the markets bottomed 7 days into the crisis. 5 days before that crisis ended, the market was already recovered 2/3 of the losses.
And that was only, Nancy, nuclear holocaust. I mean, that literally was, we're going to break the world in half with ICBMs. I mean, that was, compared to tariff worries and a slowdown in the economy because we might slap something on European wine or steel, seems very small now. That's
exactly, and that's been my whole point about this sell-off. I'm like, investors have gotten so weak mentally. I think I was actually talking about this on the reaction channel the other day. When we're looking at these sentiment numbers, and it's among the worst we've seen since a great financial crisis, the worst we've seen since, you know, things like what they're talking about there. I'm like, this is what people are so scared over. I'm just thinking back to the things I've been through in my 16 years in the stock market. I've been through some stuff, man. Like Rona, when they're talking about closing the economy for 3 years, that was scary. It was like, is anybody going to even be left that didn't go bankrupt? Like, what? Jeez, like this? Come on.
Again, and I'm not saying the markets are going to recover next week. I don't know. We're talking about history, and I don't like to bring up politics, Nancy. It always makes me feel like I need a shower, but I will ask you this. How much of this correction that we are seeing do you think 100%, 50%, 0% is political, is man-made, is tariff-made?
It's funny you asked that, Brian. It's good to see you. If you look at the consumer sentiment numbers today, and I commend everyone to read Kelly's piece that she wrote this morning, but if you look at behind it by political party, what you see is that Democratic sentiment has not been this low, especially on expectations, ever. And so if you look sentiment overall by party, Democrats down from 91.4 all the way down to 41.4, while independents and Republicans are down somewhat but have held up. And then on expectations down from 28.2 down from 93.1 to 28.2. So that's driving some of these sentiment numbers that the market's keying off of. And I would just point out that the bond market is not panicking. And so this notion that we're going to go into recession because the Atlanta Fed GDP now number was revised down, that was driven by imports. They were up 70% in January as purchasing managers trying to get in front of tariffs. So I think just like in 2022, this will all settle in. We are seeing decelerating growth, but that's good for many of the names that have been punished, the reliable earnings growers in technology and consumer discretionary and some financials even. So I think we will continue. This is a correction. We needed one. We get one every 12 months. And so now the question is, have we hit the bottom? Do we have a little more to go? But I don't think we're in a bear market.
Nancy, that's exactly what Jay Woods was saying in response to what I heard. He said, yeah, it's so bad, you're right, but it's so bad that some of the markets might take it as a sign of capitulation. You know, how much worse can sentiment get from here? And if so, does that kind of, you know, or other technician looking for a rebound, you know, maybe it's for the near term, maybe not, but do you think it's so bad that it can't get worse from here?
Almost, Kelly. I mean, if you look at the bull-bear ratios, those are near recent lows, and they tend to be good contrary indicators. I would also just say that these, you know, you tied the consumer sentiment back to June of 2022. Mm-hmm. I mean, that wasn't a horrible time to be buying stocks.
That's his point. Exactly.
Yeah. In October. So I think this is one of those times when you are disciplined and you add to the names high quality, good management teams, and you just keep adding until we get through this.
Yeah, you know, Tom, it's weird. I posted something yesterday about losses and whatever on Twitter, kind of a tongue-in-cheek response to a non-business.
And that's the thing a lot of people don't realize, right? Let's say ELF. People would be like, oh, it's risky. Buy a 66 today. What if it goes down to 56 next month or month after or whatever, right? You know what's a lot riskier? Not buying ELF at 66, and then ELF goes to 266 over the next few years. That's a lot riskier than buying ELF at 66 and it goes down to 56. If it goes down to 56, sweet, I'll buy more shares. And I'll hold. But you know what? I can't accept not buying ELF at 66 and then I see it at 266 in a few years from now and I'm thinking, oh, remember when I was so scared it was going to go to 56? AMD, I buy it at 99. Somebody says, oh, it's going down to 85. Sweet. Go AMD, go down to 85. You think I care? I don't care. You know what I do care about? I do care that AMD is probably going to be $399 in a few years. So I'd much rather buy it at 99 and it goes down to 85 and I say, darn, I should have waited a few more days or a few more weeks to buy it. I'd much rather be in that situation and it goes to where I think it's going over the next few years. This short-term crap, man, means nothing. Nothing. There's so much risk in seeing assets at great prices and not buying those assets. That's where the real risk is. Not in, well, it might go down a little bit more short-term. No, give me a break.
I heard on like a non-business network about retirees, quote, being wiped out. Thought it was a stupid comment, so I basically said that. It's probably a stupid tweet. I got beaten like your rented mule's rented mule. Fair enough. The point I was trying to make is that it is a scary time. And when things go down, there are negative repercussions. But at the same time, we have learned that a lot of our friends and family and viewers often will sell at the wrong time and buy at the wrong time. Yeah. How do we prevent those kinds of mistakes that we end up looking back on and going, why did I do that?
Yes. Well, there's maybe two things I want the viewers to understand. The first is that this is a waterfall stock market decline. A correction in a month down 10% from a 52-week high. It's unusual. When we look back at waterfall corrections, and it's a piece we did 3 years ago, the market tends to make a symmetric rebound. That means we could be back at all-time highs in 6 weeks. So for anyone who thinks that they've lost 10% and it'll take them forever to make that back, if they are patient, they might make that back in 6 weeks. The second thing is...
Exactly. That's where the real risk is. The real risk is not buying stocks, and then we're back at all-time highs in 6 weeks or 8 weeks or 10 weeks or whatever, right? Or 4 weeks. And then people are looking back like, why weren't we buying when the NASDAQ was down like 15% and then the NASDAQ's right back to all-time highs? That's where the real risk comes in. If the market goes down more short-term, sweet. I'll buy more shares. I buy every week, right? You got more income than expenses. You should be buying stocks every month, or at least every 2 weeks, 3 weeks, something like that, right? The real risk is in not taking advantage of corrections and crashes. That's the only thing we know 100% throughout time. If you do not buy stocks during corrections and crashes, you are making the biggest mistake. And that's what we know consistently throughout time. Fascinating.